Principles of Finance with Excel Modeling, copyright Lou Gaddis. Topic 7, Financial Risk Management. In this topic, we'll talk about the IMM, Identify, Measure, Mitigate Risk Management process. We'll talk about how we can measure and identify our exposures to risk using best guess, point estimates, worst case, best case, hypothetical stress tests, scenarios, break-even analysis, data tables, and EAR, earnings at risk. What we're going to do is we're going to use a television show on the Discovery Channel called Gold Rush. It follows 5 or 6 men as they try to find gold in Alaska. And here I've collected some data of a point estimate for their season 2 of Gold Rush. And what I did is I collected data from watching the show over time, and I came up with a point estimate of their net income and free cash flows. So here's what it looks like, and we're going to get into detail in a minute. They spent about $200,000, I made that assumption, on the staff of 4 or 5 in labor costs. When they go to Alaska, they have to wait until the ground has thawed. So there's only about 150 days in the area of Alaska that they operate in which the ground is soft enough to excavate and to find the dirt that has the gold in it. About 75% of the time in which they could possibly gold mine, they do gold mine. That might be because of, say, equipment breakages or delays in getting a claim. So in this year, we're going to forecast a point estimate of 113 days they'll be able to operate. And on average, they get about 12 tons of dirt dug up. Now that dirt is dug up and sent to a wash plant, and that wash plant will then, using high pressure hoses, spray down that dirt down a conveyor belt, shake it around, and the gold will fall down the bottom. So of them, there's 113 days they're actually operating. They'll get about 12 tons of pay dirt per day to the wash plant. On average, they get about 0.25, a quarter of an ounce of gold per ton of pay dirt. So I'm going to forecast they're going to have 1,350 tons of pay dirt, a quarter of an ounce per ton. That gives them 338 ounces. The spot price of gold was $1,600 at the beginning of the season. They also are going to use 200 gallons of diesel fuel per day that they're operating. Diesel fuel costs about $4.05 at the beginning of the season, and it's expected to grow by 2%. And that's just an assumption. We'll assume they are going to have non-cash working capital, actually changes in non-cash working capital equal to 10% of sales, and their tax rate is 30%. I'll also assume that gold is expected to appreciate by 2%, and it'll be gold will be $1,632 per ounce. Now, the way I'm going to model this is I'm going to assume that they pay all their expenses at the end of the first year. So just for simplicity, I just want to do a 1-year forecast. So they hold all their gold and they pay at the end of the year, and they pay off their bill and all the gas at the end of the year. So the basic model is they're going to start with they're going to figure out 338 ounces of gold times 1632, and they'll switch over to the model, and let's forecast this baseline forecast. So here's my base case forecast. The expected gold price is $1,600 times 1 plus the expected growth in gold prices, 2%, which gives me a base case revenue of 338 ounces times 1632. My variable expenses are above. We'll just say they're going to be $200,000. That's just labor cost. Now fuel. Fuel is going to cost, and there's a note here to the side of the spreadsheet, but the fuel is they're going to be operating for 213 days. Each day, I did a negative sign in front of that. Each day they're going to use about 200 gallons of fuel to operate their 4 pieces of equipment, including the wash plant. Fuel will cost $4.05 per gallon times 1 plus the growth rate of fuel. So 113 days using 200 gallons a day at $4.05 times 1.02. So that's going to give us $92,000 $948 in the first year. Now depreciation, if we zoom out a little bit and come over here to the right, I'm going to assume that they're going to need the 4 pieces of equipment: a bulldozer, a wash plant, an excavator, and a loader. It's going to cost $440,000. I'm going to assume they depreciate that over 5 years. So if I take, for the calculation depreciation, I do a negative of my CapEx, that equipment. I'm going to anchor that because I want to drag that across eventually, divided by my 5 years. And that's going to be the depreciable life on this. All right. Well, it's going a little slow there. There we go. Divided by 5 years. I'm going to anchor that. So 88,000 depreciation in that year. That gives me 169 of EBIT. I'll assume no interest because I want to calculate an unlevered firm, a firm with no debt. And our tax rate is going to be the EBIT. I'm going to subtract minus the EBIT times the tax rate, which is right there. That'll give me net income, my point estimate of $118,897. I'm going to add back the depreciation to get to free cash flows. I'm going to subtract the change in working capital. I'm going to skip over CapEx for a minute. So I have a note here. This is the non-cash working capital change as a percentage of sales. All right. And I just did that for simplicity. Normally what I would do is actually forecast working capital and calculate the percent change. We'll just say the change is equal to 10% times sales. Now the last thing we have to do is deal with CapEx and residual. Now for modeling simplicity for this one particular model, I don't want to focus too much on CapEx and residual values, but so I just made a simple assumption. Is I just want to forecast 1 year, and since these people that go to Alaska and do the gold mine, they don't live in Alaska. They actually travel there. They stake a claim, they buy a claim or rent a claim, a piece of land. They buy equipment, and then they get rid of it at the end of the year and go back to their normal homes in the winter. So how I've modeled that is, again, up to the right here, where I have my CapEx. I've forecasted, let me just actually put it equal there. I've done a forecast that if they sell all their $440,000 of equipment back at the end of the year, and say they get 80% of it back, they'll get $352,000 when they sell it at the end of the year. Again, we're going to amortize it over 5 years, but then we're going to sell it at the end of the first year. I then calculated the after-tax residual, that if you sold it for $352,000 and then pays taxes on the difference between that $352,000 and the book, I wind up with this after-tax cash flow. And then I just did a summation just to make it simple. I know I spent $440,000 today, and then I'll get back $352,000. That net is negative $88,000. I'm just going to put that down here. And again, it's just for simplicity's sake, to just that way I just talk about a 1-year model. And I'm going to anchor that. So now I'm going to forecast, I have free cash flows. My point estimate is free cash flows of $63,000. So that's a point estimate. That would be a starting point for doing analysis for whether or not Todd Hoffman should go and look for gold in Alaska. Now what I did is to get kind of an idea of the range of what cash flows could be and earnings could be, I made a worst case and a best case scenario. So the worst case I said is they're only going to find 0.1 ounces of gold, and the season's going to be shorter, and they're going to be the more breakages of equipment, so there'll be less time to work on digging up the dirt. So I made some assumptions of kind of everything going wrong, including gold falling by 40% and fuel prices going up by 40%. And then I flipped it. The best case scenario is the season gets longer, we have a higher percentage of time, fuel prices fall and gold prices rise. So all the good things happen. Now, if we anchored these correctly, we should be able to just drag our analysis across and calculate the best and worst. Okay, and what we see is our best case is he makes $632,000 a year in that season. Worst case is he loses $222,000. Again, the best case is gold prices going up and fuel prices going down, and the season is longer. So this is normal for a simple analysis, is do a worst case and a best case to kind of talk about what are the extreme range of outcomes. However, what's bad about that is it doesn't really give you an idea, well, why would there be a situation where all the bad things happen and all the good things happen? So a common technique in risk management or sensitivity analysis is to think about hypothetical scenarios. So I thought of 3 of them. Let's look at this one here. What if I just took one scenario? What if it's just a terribly long and cold winter and they'd only got 130 days? Well, I just made that one change, and I say, well, what's the impact on having a cold winter and having to wait around until the ground thaws? Well, that one we only wind up with 28,000. And then I just made up some scenarios. What if there's a global economic boom or a global economic bust? Now, that wouldn't affect the environment at all, right? The economy is not going to be driven by how cold the winter is in Alaska. However, the assumptions I did make is if there's a global boom, the stock market is booming, the world economy is booming, there's going to be demand for fuel and fuel prices will go up. However, generally in a global boom, gold prices go down because gold prices actually usually go counter-cyclical, that people buy gold when they're worried about the economy falling. So I have a global economic bust, where the economies are slowing all over the world and gold prices are going up because then people are worried about the world falling apart, and that's the same time in which diesel fuel depreciates. So what that gives me is an idea of kind of the best case. My range is my worst and the best. My base case and my range of worst and best. And then I have 3 scenarios that I can think about. And it looks like one of the best scenarios is that global bust where gold prices are going up and fuel prices are going down. So this allows me to identify my exposure. So this process lets me realize that my exposures of this business are several. 1, cold winters. A cold winter will decrease the amount of time I can mine. And a depreciation of gold prices is a bad thing, and appreciation of fuel prices. In addition to other things like the percentage time that I'm able to mine. So what I can do is I have this already graphed that here's net income and free cash flows, my base case, my worst case, my best case, my global boom, there's the good global bust, and then the long winter. So this is doing sensitivity analysis. Now what we're doing here is following a risk management process. And this risk management process, a common way of thinking about risk management, financial risk management, is identify, measure, and mitigate. So we've now identified through this analysis the factors that affect the viability of our enterprise, the gold mine. And those are gold prices, fuel prices, and the weather. We've measured how the risks affect the cash flow and profitability. We've done a worst case and best case. We've done some scenarios. What we're going to now do is some sensitivities, some break-even analysis, and earnings or risk. And later, in another topic, we'll talk about how we can mitigate the risk after we've identified a risk and measured them. So now we're to this point here. We now have our scenarios. We got the graph there, right, that kind of looks at the different scenarios. And let's talk about so far what we have. The advantages and disadvantages of the scenario analysis. The main advantage is it's better than a single point estimate. Right? A single point estimate doesn't really tell me much about how risky, doesn't tell me at all about how risky an enterprise is. So the worst and best cases gives a range of possible outcomes. And the advantages of doing the scenario analysis is we analyzed the environments that may be detrimental or advantageous to our enterprise. Now, the disadvantages of what we've done so far is it didn't focus on the key factor sensitivities. What it really is our exposure to gold. Doesn't identify break-even points. What price of gold does this gold mine, this gold mining operation not make money? And what's the likeliness of the scenarios? How probable is it that gold prices will fall? So we're going to try to answer that with the next few measures. So the first thing we'll do is some key factor sensitivities. We'll do a 1-factor and a 2-factor data table, and then we'll do a break-even analysis. So let's do that. I'm going to hide this column H. And here's my spreadsheet. First thing I'll do is I'm going to do a one-factor sensitivity analysis data table. So what I'm going to look at is just gold appreciation. So I'm going to set up a data table where I have values of gold appreciation in a column, and then I'm going to have a link to my base case revenue, my base case net income, and my base case free cash flow. All right, it's just a link to those values. And what I'll do is I'll then highlight this grid and click on Data, What If, Data Table. And I'm going to do a one factor. The only factor I'm changing is gold appreciation. So I'm going to click on, that's in a column. So I'll click on Column, and then I'll click on the input that drives those three numbers, which is right here. This 2% appreciation drives the price of gold, which then drives all these numbers. So if I hit OK, here's my base case. My base case is a 2% appreciation, but then it shows me my exposure. So it looks like we're generally okay for plus or minus 20%. It's only the free cash flows turn negative when you get about a 20% decline in gold. Now we could do a two-factor. We could look at, say, gold ounces per ton of pay dirt and gold appreciation. We do a link to, say, free cash flow right here. And then I can highlight this. Data, what if, data table. My row input is the amount of gold in each ton of dirt. That's right here. My column is the appreciation of gold. So now I have two factors. And it looks like what's really killing us here is if we have low gold amount per ton of dirt, and if the gold devalues, looks like by 20%. Now the next step would be to do a goal seek using a break-even analysis. What amount of gold do we need to find to break even? So I can just do a goal seek. Data, what if, goal seek. Let's set my free cash flows to 0 by changing the amount of gold in the dirt. So I can hit OK. So it looks like at 0.20 ounces per ton, free cash flows go 0. Hit escape. So it looks like 0.2 is the minimum I need. It's the break-even amount of gold per ton of dirt. And I can do the same thing by doing a what if goal seek. Set my free cash flows to 0 by changing the appreciation of gold. That's the 2% right here. I can hit OK. And it looks like if gold goes down by 17.7%, my free cash flows go negative. So I can write that in. And I can see my exposure to diesel fuel prices. So I can do a what if, data, what if, goal seek, set free cash flows to 0 by changing appreciation of fuel. And it looks like I only go bankrupt, or I only have negative cash flows if fuel prices are more than double, 102%. So I can type that in. So now what we have is a full analysis. We've looked at our base case, our worst and best case. We look at hypothetical scenarios, making sure we're thinking about how it would affect our business. Calculated free cash flows and net income of all those, and that's incorporated in this chart. I then looked at just my exposure on gold and how it affects revenue, net income, and free cash flow. I looked at how gold and gold ounces per ton of dirt affect my free cash flow, and I did a break-even analysis and found that I need to make sure that I get at least 0.2 ounces of gold per ton. I need to make sure gold doesn't fall by more than 17% or fuel go up by more than 100%. So that so far is pretty good analysis. Now the only thing that's wrong with this analysis is it didn't address this last problem. We have no indication of the likeliness of any scenario. Like how likely is it that gold will fall by 17%? So what we can do is we can calculate something called earnings at risk. All right, you can also do a cash flow at risk, but we're just going earnings at risk. And what earnings at risk is, it's a probabilistic measure of worst case. It's a probabilistic measure of how much earnings could be less than what we expect. And EAR requires us to specify what time horizon and what confidence interval. So for example, what if we're going to calculate the 95% confidence interval, 1 year EAR. So say this mine's 95%, 1 year EAR is $93,000. We're going to calculate that in a second or a few minutes. If our 1 year 95% EAR is $93,000 and our expected profits on our base case are $118, that means that there's a 5% chance that earnings will be $93,000 less than expected. So there's a 5% chance earnings will be $25,000 or less, which is $93,000 less than the expected amount. So the EAR is literally the amount that profits could be less than expected. And why we say it's the 95% confidence interval is using this analysis or the thought process here, we're 95% confident that profits will be at least $25,000 or more. However, if the EAR is $93,000 and base case earnings are $118, there is a 5% chance cash flows will be less than $25,000. Well, let's show how I calculated that number. The EAR is this formula, V times sigma times Z of X times 1 minus the tax rate. The V is the quantity of the good, in this case gold, we're just doing a gold earnings at risk number here, is the value of the gold today, which means our total quantity times today's price, today's spot price. Sigma is the standard deviation percentage annualized of gold appreciations. Z of X is the Z value from a normal distribution one-tailed test table that's consistent with that X percent. So it's Z of 0.95 for a 95% EAR. And 1 minus the tax rate. So let's look at how I calculate EAR for Hoffman Mines. They expect to mine 337.5 ounces of gold in 1 year. The current spot price of gold today is $1,600. So the total value of the position today is $540,000 using the total expected quantity and today's price. Let's just use a standard deviation of 15%. The Z of 0.95, so a 95% confidence interval EAR requires us to calculate Z of 0.95, and that's 1.645. What that means from a Z one-tail test table is you are 95% confident that if a variable is normally distributed, and I should have started off by saying this formula only works for a normal distribution of the variable, gold appreciation, that we are 95% confident of not having a 1.65 standard deviation adverse change in the variable, in this case gold. Or there's a 5% chance we will have a 1.65 standard deviation change from the expected. So if I multiply Z times my sigma, 1.65 times my sigma, my standard deviation of 15%, that's 24.67. What that says, there's a 5% chance gold the percent change in gold will be 24.67% different than expected. If the expected value is 2%, and there's a 5% chance they'll having a 24.67% change from that, that means there's a 5% chance gold prices will fall by 22.67%, assuming it's normally distributed. I plug in my numbers, and I get that 93,263. Again, I calculate my Z, which is 1.65, multiply my Z times the standard annualized standard deviation. That says there's a 5% chance gold prices fall by 22%, which is 24% less than expected. That 24% is then goes into my VAR formula, and that tells me there's a 5% chance that earnings will be $93,000 less than expected. Now I went ahead and plugged this into Excel. Let's go back to Excel model and go to the EAR tab. Here's my calculation. Here's the total value of the position today, quantity times today's price, 15% standard deviation, 95% confidence interval, and 30% tax rate. There's my Z of X. You can use an Excel, norm SINV, and put in the X of 0.95. That gives me a Z value of 1.645. And then I just calculate my EAR. V times sigma times Z of X times 1 minus the tax rate, 93,000. Now I went and improved it here. Notice I've taken the base case and I copied it here. And then the only thing I changed is this one cell. What would the profits or free cash flows be if the change in gold prices was negative 22.67%, which is negative 24%, is 24% below the expected. And that's what I calculate here. That's Z times sigma. So if that happens, notice that the profits go to 25,634, which are 93,000 less than expected. And that's what EAR exactly is calculating. In this case, it's calculating my drop in profits, or I'm sorry, my drop in net income if I have that 5% worst case scenario in gold, which is a negative 1.65% change, 1.65 standard deviation change. So that's EAR. Now, let me show you how I calculated how you can calculate that standard deviation, because everything else seems pretty clear, but where do I get the standard deviation? Here's just an example. I collected some gold prices the other day. So I'm going to do a percent change. It's from 2014 to 2016. So let me take the price of gold in February 2014 minus the price of gold in January divided by the price of gold in January. That's the percent change. And let me copy that for my 30 months or so here. And let me use Excel's function STDEV and calculate the standard deviation of gold price changes. So what I get is a standard deviation of 3.285. Now notice these are monthly prices, monthly percent changes, so this must be the monthly standard deviation. Now I can't just take, but that formula requires the annual standard deviation. The problem is I can't just take the monthly standard deviation times 12. All right, that is not the answer. All right, standard deviation is the square root of the variance. Variance is the average squared deviation from the mean. When you try to adjust standard deviations for time, you don't multiply times time, like multiply monthly times 12. The only way to correctly do it is multiply times the square root of time. Because remember, standard deviation is the square root of that variance. So if I take the monthly number times the square root of 12, that would be my number, 11.378. That's probably what I should have used here, 11.378. All right, but I'll just leave in 15 for now. But this is how you'd calculate it. Now you can also use the square root rule. What if I have the monthly standard deviation, but I'm trying to get daily? Well, I can multiply times the square root of 1 over, and let's just use business days. Right, this data that you collect on prices, either stock market or commodity market or currency markets, they're not open every day. So when you collect data, there's usually about 250 to 260 trading days in a year. So we use that, and there's about 21 trading days or business days in a month. So if I take 121, the square root of 1 over 21, that'll give me my daily standard deviation. Whoops, I have to start with monthly. If I take the monthly standard deviation times the square root of 1 over 21, I get my daily standard deviation. Now I could have done it another way. I could have taken my annual standard deviation that I just calculated here times the square root of 1 over 252. Again, the number of business days in a year. So it doesn't matter which way I do it, but I can scale volatility up or down. In other words, I can scale standard deviations up or down, not by multiplying and dividing by the time increment, but by multiplying and dividing by the square root of time. So if you have an annual standard deviation, if you want to calculate an annual standard deviation, but you have daily data, multiply times the square root of 252. If you have annual and you want to get daily, multiply times the square root of 1 over 252. If you have monthly and you're trying to get daily, multiply the monthly times the square root of 1 over 21. If you have annual and you want monthly, multiply times the square root of 1 over 12. And for weekly, 1 over 52. This is important because this is going to allow us to actually calculate an EAR for any time interval. That we can simply change our EA model to calculate our exposure to a 1-week change in gold prices or a 2-year change by simply taking the standard deviation and adjusting it for time. So here's my general model I can use for EAR that accounts for this time. My EAR for T number of days, and these are business days, given an X% confidence interval is V times my Z of X times 1 minus my tax rate, right? Because I get a tax shield on losses, times my annualized standard deviation, times the square root of T days over 252. So I'll go ahead and put that in. V times Z of X. Well, I need Z of X. Let's calculate that. Equals norm S INV of 95%. Forgot my S. Norm S INV. Norm S INV. So there's my 1.645. So if I take my V times Z of X times 1 minus the tax rate times, now here's the trick, square root of T days divided by 252. Now remember, 252 is roughly the number of days in a year. So if I want the 1-year EAR, just type in 252 days. Whoops, I did one mistake here. Let me see. It's not coming out to exactly the number. So let's see what I did here. I take my V times my Z of X times 1 minus the tax rate times the square root of of T divided by 252. Well, looks like I'm making a mistake. Let's try to figure this one out. Whoops, I forgot to multiply times my standard deviation. There it is. All right, times I missed that little sigma. So there we go. There's my 93,263. So 252 days is a year. However, we can use this analysis to say, well, what would be our exposure for if this operation took 2 years? Well, I can do a 504-day exposure. What if this operation took 6 months? Well, that would be my exposure in 6 months, because gold price standard deviation over 6 months would be much less than gold price appreciation over a year. So this is how you can scale your standard deviation over time, which then scales the EAR. And this is why it's a popular number. Also, we can just change this to a 99% and get the 99% confidence EAR. Let's use 252 days, again, 1 year. My Z of X is 2.32, so there's a 5% or there's a 1% chance of having a 2.32 adverse change, at 2.32 standard deviation adverse change. So my 99% EAR is 131. So now this allows us to make more statements about the risk of this business. This is the base case. This is my worst case and best case, my range. Here are 3 hypothetical scenarios: a global boom, a global bust, a long winter. This is my 1-factor sensitivity of gold. Here's my 2-factor of the interaction of gold and ounces per ton of pay dirt. Here's my break-even analysis. And then lastly, here's my EAR, 95% confidence interval and 99% confidence interval. So this is what we can use to help Todd Hoffman decide whether he wants to go to Alaska. So again, the process, what we focused here is we've really, this analysis we did allowed us to identify what our exposures are, measure how those exposures affect cash flows and profitability. The next topic, we'll talk about how can we then mitigate the risk. We've identified what we're exposed to. We know how big the losses could be. Now it's a matter of, do we accept the risk and do nothing? Do we lay off the risk? In other words, go home and cease operations? Do we hedge the risk with things like insurance or derivative contracts? Or do we just hold capital? In other words, we just hold a cash cushion just in case things go bad and we need to draw more money. So all of these will be discussed in the next topic. So in this topic, we understood the IMM risk management process, and we measured our exposure, identified our exposure by using worst case, best case, hypothetical stress tests, scenarios, break-even analysis, data tables, and earnings at risk.